What I'm going to do, obviously, for the first time for quite some time, Vietnam seems to have come back onto a few people's radars. There's been some coverage in various publications, particularly here, such as Barron's and the Wall Street Journal, and that, I guess, is predicated on the fact that Vietnam has the world's best performing stock markets, both month and year to date, which of course are the same thing. So what I've done, and if this is too basic for everybody or anybody, please excuse me, but I thought it was best to run through it from the top, just to give you a full idea of why we think it's an interesting proposition, other than the fact that this is all we do. So obviously we would think that was interesting. From the top, the basic landscape, if you like. Vietnam has a large, young, well-educated population. One of the highest literacy rates in the world, roughly 95%. 60% of the population is under the age of 35. Very hard-working and very ambitious to improve their lives. Vietnam offers a low-cost production base, similar to China, but probably now something like a third of the price in terms of manufacturing wage levels. It has been historically low cost, low value add, particularly on the industrial manufacturing side. But as we'll see, Vietnam is beginning to move up the value chain. The primary exports in terms of cash generation, if you like, garments and footwear. Vietnam is a crude oil exporter. And electronics is the recent star, if you like. In terms of not enormous amounts of cash, but global positioning, Vietnam is now the #1 rice exporter in the world, after Thailand decided that they would buy domestic rice for a far higher price than the world is prepared to pay for it for political reasons. #2 exporter of coffee after Brazil. #3 in natural rubber after Indonesia and, I believe, Thailand. It is, to a certain extent, if you like, mini China. Similar economic drivers being exports plus domestic demand, as that large population starts to become slightly more affluent, so they spend more money. And foreign direct investment. Now, you might occasionally see some discussion of levels of foreign direct investment in Vietnam, and that in 2012, foreign FDI fell by about 24%. Now, people tend to report whichever number has the most interesting interpretation, but one should always look at disbursements rather than commitments when talking about FDI in Vietnam. For the last 3 years, Vietnam has had roughly $10 billion of disbursements. In 2008, commitments were $65 billion, which at the time was roughly 65% of GDP, and other than Myanmar or Burma, if you prefer, in about the last 3 weeks, that has never been seen anywhere. So there was never any chance of that $65 billion turning up. So as we say, keep an eye on disbursements, and that's pretty steady. And you know, as the world gets more money again, hopefully, we would expect to see that rise. In terms of where we are from a macro level, Vietnam in 2008 and then again in 2011, in its 3-year boom-bust cycles, had serious problems with very high rates of inflation, which in 2008 got as high as about 28%. In August 2011, Vietnam had an annualized inflation rate of 23.2%, thanks to very determined and consistent application of monetary policy. The government has managed to reduce that, or manage within a year to get that number down to 5.1%. The full year was 6.8% for 2012, which is a fairly impressive performance. Vietnam has had, certainly in the time that I've been in the country, which is about 10.5 years, the exchange rate against the US dollar has depreciated by somewhere over a third. At the same time, as part of introducing a much more focused long-term government monetary policy. The government devalued the currency by about 8.5% in February 2011, subsequent to which, because of the high interest rate policy that they operated for the next year, the Vietnamese dong has been the most stable currency in certainly in Southeast Asia, possibly the whole of Asia, since February 2011, and continues to do so, and we'll talk about that in a little more detail shortly. In 2012, Vietnam had its first trade surplus since 1992, and that fits in with the mini China story, if you like, because 20 years or 25 years ago, China used to have trade deficits as it was industrializing and modernizing its economy, and nobody remembers that anymore. But Vietnam is, is moving along a similar path, if you like. This will give you some idea of the boom-bust cycles. The white line is the annualized rate of inflation. As you can see, as I mentioned, back in 2008, up near 30%, and last year, 2011, was about 23%. So we've seen, we saw first of all, obviously, the monthlies come down, and that was followed by the annuals. So it's fairly steady now. We've picked up to just above 7% for January, which, and Vietnam's economic data collection month runs from the 21st to the 20th. So we have had January economic data already. The first month or two of the year is always the high point, if you like, or generally the high point of price increases. We have the Lunar New Year, also known as Tet, and not always followed by the word offensive. And because the country essentially takes, officially takes a week's holiday, but in practice takes about a month's holiday, just before Tet, prices do tend to rise. So we do think that 7% is probably going to be the high point for the year to date, and it should come down to about 6 to 6.5 for the full year. Vietnam does have an exaggerated inflation number. The composition of the CPI basket hasn't been changed for about 15 to 20 years. Food represents 42% of the CPI basket, transport another 10. Over the period from 1993 to 2008, the number of, or the percentage of the population that lived below the poverty line in Vietnam has been reduced from 54% in 1993 to less than 10% now. And you would think that, given that sort of move in the poverty level, that there would be some change in the components. But and so Vietnam does tend to suffer by being consistent in its data, the application or the interpretation of data. This just shows you how good a job the government has done in the last, coming up to 2 years since the last devaluation. The currency has a managed board against the US dollar with a 1% daily movement limit around the pivot rate, but has been extremely stable, as you can see, over that period. A bit more on the balance of trade. From 2007 to 2011, you can see that Vietnam ran fairly substantial trade deficits that came down quite nicely from 2010 to 2011. The 2012 number, since I produced this slide, has been modified upwards, and in fact came in at 0.76 billion, so $760 million of trade surplus. Now, the reasons for that change are, firstly, that exports have continued to be strong in spite of the global slowdown, so up about 19% last year. The major category of imports over that period, 2007 to 2011, were machinery and capital goods. Now, that is part of the modernization of the economy. Obviously, with infrastructure, one needs a lot of large machinery. Once you've bought the machine, unless you break it, you don't need to buy it again, and it then becomes productive capacity, if you like. So that's been another reason for, a main reason for the fall in imports. I said that Vietnam is a crude oil exporter. Up until 2 years ago, Vietnam had negligible onshore refining capacity. Over the last couple of years, it's opened 2 refineries in the middle of the country, which now refine roughly 30% of Vietnam's oil production. So that, again, reduces the import side of the equation. And then moving up the value chain bit, Vietnam, as I said, traditionally low cost, low value add, and the largest export has been garments and footwear. And so essentially what Vietnam was doing was importing textiles mainly from China, turning those textiles into t-shirts and exporting them to, for example, Gap and Walmart. Over the last year or two, there has been, with the FDI that's coming in, there's been a move to more value-add manufacturing. So, for example, Intel have their largest production facility globally just outside of Ho Chi Minh City now. Samsung, who have just announced a doubling of their manufacturing or assembling capacity in Vietnam, already produce roughly 25% of their smartphones. And as I say, have just announced a doubling of their investment to increase the size of that factory. So they will be moving up to in excess of 40% of their production will be from Vietnam. So, you know, although assembly is not manufacturing per se, there's obviously a higher value add component in assembling a smartphone than in making a T-shirt. So again, the add-on from the import to the export is significantly greater than it was in the T-shirt day. And what we've seen, I'm sure you hear of Cambodia and Laos being other Indochina emerging or frontier markets. So a lot of, as Vietnam moves up the value chain, so the lower end of the value chain is moving to Cambodia. So Cambodia is getting more garment manufacturing. The difference, I guess, or one of the differences, and the reason that we are interested in Vietnam and not interested in Cambodia and Laos, the basic proposition in Vietnam is the large population and the natural resources that Vietnam has, which are not present in either Cambodia or Laos, for example. Cambodia has a population of about 11 million, and Laos has a population of about 5, so they're never going to be Vietnam any more than Vietnam is ever going to be China because of size. But you know, Vietnam is certainly moving along the same path as China and in the same direction. It's not all good news, obviously, nothing ever is. The high interest rate regime that the government introduced in February 2011 was not without consequences. Obviously, if you are a small business and suddenly your cost of capital increases significantly, that does put some pressure on your profitability. So there was a surge in bankruptcies. The NPLs in the banks are as yet unquantified, but are certainly higher than the 4% recognised. Somewhere between 10 and 15% is probably the right level. At 15%, essentially the entire capital of the banking system is wiped out. And so the banks do need to be recapitalised, not all of them. There have been rumours recently that Agribank, which is the largest state-owned bank, has NPLs to the extent of roughly 75% of its loan book, and if that is true, that would be more than half of the NPLs in the system. So the government will be needing to sort that out as a matter of priority, and they have recognised that fact. There is an asset management company or a debt asset trading company being set up, which will take hopefully some of the NPLs off of banks' loan books so that they can start lending money, hopefully in a much more sensible way in future. We do expect at some point the foreign ownership limit in banks, which is currently 30%, to be increased to at least 49% in order to help with that recapitalisation process. The other impact of the monetary policy, high interest rate regime, is that GDP growth, which averaged in excess of 7% for the previous decade, slowed to a touch over 5% in 2012. Conservatively, that should pick up to about 5.5% this year and 6% in 2014. So I'm pretty sure we've seen the worst of that, and particularly, obviously, if China and the US manage to increase the pace of their economic growth, and Vietnam should be a fairly large beneficiary of that resumed growth elsewhere. Now, what we are hoping for, and what we, to a lesser or greater extent, are expecting to see very shortly, an effective roadmap leading to the recapitalisation of the banking sector, is the asset management trading company that I mentioned earlier. Apparently they are quite close to finalising that. The World Bank have been consulting, and the IMF. The World Bank last week said that money is available to Vietnam should it need it in terms of sorting out its problems. It's very unlikely that Vietnam will choose to go that route, but it is there, which does to a certain extent provide some comfort from an underwritten perspective. State-owned enterprises have been a very major source of wasted resources. A company which is theoretically the oil production and exploration company, Petro Vietnam, obviously one would be unsurprised to hear that because they are supposed to be drilling for oil, they also have a luxury apartment development business. They have a securities company, a couple of banks, and various other businesses that will no longer be regarded as essential to the operation of that particular enterprise. So between now and 2015, state-owned enterprises have to divest themselves of all non-core businesses. That should enable the economy to start operating properly. We're expecting an increase in foreign ownership limits. I mentioned that banks, the foreign ownership limit is 30% currently. It is a maximum of 49% for everything else, and that's only listed stocks, because outside of the stock market it is possible for foreigners already to own 100% of businesses that have not sold shares to the public. Now, it does seem quite counterintuitive, if you're trying to encourage a stock market or capital markets to develop, that you have more restrictive foreign ownership limits for listed stocks than for unlisted stocks. So we do think that will be brought in line in time. The first thing, and what seems to be likely in this quarter, is the creation of a class of non-voting shares, which will effectively increase foreign ownership possibilities by 10%. We're not convinced that they've thought that through. They are touting this as a development similar to the Thai model, but Thailand had a foreign board before it had non-voting shares, and we don't have a foreign board. So how that will improve the market for those of us who own foreign shares which have votes attached remains to be seen, but the discussions are ongoing. In terms of where we are from a micro basis, the Vietnam index, and as I said, since I wrote this, the market has continued higher. So we are on roughly 11.2 times 2012 earnings and about 10 times 2013. The historic trading range, as a point of comparison, is 8 to 35 times earnings. Now, Vietnam has only had a stock market since 2000, July 2000. It debuted on the 28th of July 2000 with 2 listed stocks. The index level was 100. 11 months later, in June 2001, the number of listed stocks had increased to 5, and the index had increased to 571. So there was obviously a feeling that it should be 100 points per stock. Since then, and over the time I've been there, I've seen the index come back down from the 573 to 130, to rise from there to 1,170, back to 235, up to 650, back down to 330, and we're now at about 480. So although the market is up 15% year to date, we are still very close to the low end of the trading range. We have 704 stocks listed on 2 markets. Market capitalization is now very close to 40 billion. So it's still a tiny market, but it's a lot bigger than it was in 2000. In fact, 1,000 times the size that it was in 2000. So fairly phenomenal growth. This is the development of the index over that period. As you can see, a fairly volatile ride, but the last several years since 2007 have been somewhat less impressive in terms of volatility. Now, we have some data points on here, or some calendar highlights. Vinamilk, which is currently the third largest stock, and we heard the earlier speaker talking about China, referring to Chinese milk consumption. Now, Vietnam similarly imports powdered milk from New Zealand and turns it into what's called fresh milk, but isn't really fresh milk, obviously. But Vinamilk has also bought stakes in New Zealand powdered milk producer, so it's able to ensure that it continues to have supply. When Vinamilk listed in 2006, it doubled market cap, took it above $1 billion for the first time. About a week later, Merrill Lynch released an extremely bullish report on Vietnam, which got the market moving, certainly in this area here. And overall, from the beginning of January 2006 to the 12th of March 2007, the market tripled. That was to a large extent caused by foreign inflows. As foreign investors discovered Vietnam, so an enormous, proportionately very large amount of money was thrown at the Vietnam market. At the beginning of 2006, there were 3 managers in Vietnam, including ourselves, managing in total 8 funds. By the peak in March 2007, there were 64 Vietnam funds. So once we went from 2007, we got through 2007 and got to the beginning of 2008. The market in 2008 dropped by 68%. So although people do say that investors have short memories, that certainly hasn't been the case in Vietnam, because it's taken until very recently for those foreign investors to start coming back. But we do, as I say, because we still have a market that is very cheap, because we have investor optimism, I think, at the moment, because investors, having seen Vietnam resolve the macro issues in 2011 and get the economy back on track, are now optimistic that they will be able to do a similar thing with the banking system and the state-owned enterprises, and also access to the market for foreign investors. Now, it's all very well for them to be telling people that they've got a plan, but we really need to know what the plan is. And in order to turn that optimism into confidence, in order to allow the market to continue its rise, and even at this level we are still 70% below the all-time high in US dollars. In order for the market to continue to recover toward that level, we do need to see some actual the implementation of, or at least the details, and then the implementation of such plans to allow more confidence to develop.